if indeed Q2 inflation print, because of a protracted conflict between Russia and Ukraine or some other factors, continues, and if the inflation spills over above 6% yet again in Q2 as well, while the longer term inflation average taken on point is well taken, what about the pressures that the short term yields on the Reserve Bank of India?
So I'll just add a little bit of another perspective beyond what Shiva said. So what he mentioned is that the rate hikes are already priced in. In fact, RBI probably will be delivering lesser rate hikes than what market is pricing in at this point of time. So from that standpoint, yields going up further significantly higher is not kind of expected. If you see repo rate is at 4%, your 10-year bond yields are above 7%, so 300 basis point spread. This is almost, and it can go up a little bit more, as Shiva said. But the bigger problem is the demand-supply mismatch, because you'll have supply of bonds hitting you every week. Last year, if you remember, April to September, RBI had bought 2.1 trillion, worth of bonds through their GSAP program. This time, who will be buying those incremental bonds? That is the problem. That is why the yields can still go up if the RBI doesn't buy enough bonds. Not because we are expecting, rate hikes to go beyond 6.5%, 7%, which is already priced in. It's more about what kind of demand for bonds buying, come in, and who's going to buy those bonds. Are banks going to be, kind of take up the entire bonds of 8.5 trillion gross number that is there for April, September, or RBI has to come in and buy some amount of bonds? So today, if you see, RBI has not said anything specific about GSAP or OMO purchases. They've just said that we'll support the bond market through different instruments. So I would expect as yields go higher, there will be kind of support from RBI through open market purchases of bonds, through Operation Twist, so that they don't add additional liquidity, but they support or anchor the longer term bond yields beyond a certain point. Probably RBI will not want 10-year bond yields to continue rising at a particular level, which can, dampen growth expectations. So that angle of RBI support and where they want bond yields to settle is important, not just from a rate hike point of view, just from the demand supply point of view. The second part is where can policy rate go up to? Now, as Shiva was saying, that inflation average is, RBI has given 5.7. Last year, FY22 is supposed to end with 5.5% inflation. This year, we are talking about 5.7. This year, as in FY23. And our FY24 forecast also suggests that inflation will be around 5.5%. So even if you assume that 5.5% average is what the inflation would be post-pandemic, the repo rate has to go up to at least 5.5% so that you have non-negative real interest rate. I'm not saying real interest rate will go up back to 1.5%, 2% positive, which used to happen in the older RBI regime. But even if you want zero real interest rate, not to create macro instability for a future period of time, the repo rate has to go up to 5.5%. So I would assume 50 basis points repo rate hike in calendar year 2022. So probably one repo rate hike in August and another one in December. I don't see RBI going too aggressive on repo rate hikes or going back-to-back repo rate hikes. Even if inflation is higher than 6% for a few months, I think RBI will go slow on the repo rate hike because the rates have already risen. RBI just has to catch up. So I would assume 50 basis points in 2022 and another 75 basis points in 2023 when the growth has improved further. Then slowly RBI is going to move the repo rate from, so if this end of the year it is 4.5, by the end of next year it could be at 5.25. That will be close to the inflation average and real rates will be close to zero. That is the framework which I have in mind while kind of calculating the terminal repo rate.